Do you ever wonder why countries can't just print more money to pay off their debts or feed the homeless, fix unemployment, or any other issue? It may seem silly, but it's one of those questions people may be embarrassed to ask, but many also wonder. One word can summarize the answer: inflation. Hello and welcome back to the Finance Guardian channel. During our video today, we'll dive more into the question of why can't the government just print more money? As always, hit that subscribe button and the bell beside it, and let's get started. Inflation is defined as a persistent, substantial rise in the general level of prices linked to an increase in money supply and resulting in the devaluation of the currency. We'll get to that, but first let's establish what money actually is. Now this may seem obvious, but one thing you should remember is that there is absolutely no intrinsic value to money. What that means is that money in itself has no actual value. It is only regarded as valuable because it can buy things. But if you were stranded on a deserted island, you wouldn't have any use for it. Money only has value because we believe it has value, known as the Tinkerbell effect. The Tinkerbell effect describes something that only exists because we believe it exists, and that is undoubtedly true of money. Hypothetically, if people suddenly began to believe that money holds no value, then it wouldn't have any value. But it wasn't always this way. As you probably know, money has been around for millennia, and when it was first used, it was in the form of commodity money. The things traded had actual value and were useful, like salt, spices, horses, and weapons. Metals such as gold and silver were also traded, which, although they technically have no intrinsic value either, are almost universally accepted as currency due to their rarity. After all, we had representative money. Because bringing everything you own can be difficult, it makes more sense to carry representative money. A bank keeps your gold safe for you, giving you a piece of paper acknowledging you own that gold. These pieces of paper may be used as money since anyone may redeem the gold at any time. But today, almost all countries in the world use fiat money. Fiat money is backed by government confidence that the money will have value. If we take the United States as an example, a relatively young country, it has already undergone all three monetary systems within the past 200 years. The Coinage Act of 1792, when the US stopped using European money, led to the creation of the US dollar. The US dollar was originally in the form of commodity money in gold, silver, and copper. The value of the metal that made the coins was precisely equal to their face value. With the 1900 Gold Standard Act, the country switched to a mix of commodity and representative money. Dollar bills were issued by the government that was exchangeable for gold anytime. The gold standard was a type of representative money used by different countries. It was an effective way to calculate exchange rates between countries accurately. Suppose 1 gram of gold costs £1 in Britain but $1.50 in America. Then you can easily equate £1 to $1.50. Gold coins were discontinued while silver was taken out of other coins, ending commodity money. Richard Nixon abandoned the gold standard in 1971 and the US transitioned to fiat money. As a result, money today is not backed by gold or anything of value. Now back to the question. Basic economics tells us that an increase in supply will decrease demand, resulting in a lower price. So with more money in the economy, each dollar becomes worth less. This would allow other countries to purchase more dollars in exchange for their currency. Supply and demand graphs illustrate why this leads to higher prices. A greater amount of money in the economy causes a shift in demand curves for goods and services. But since the economic output is not increasing, prices tend to rise. Imagine if the government printed $1 million and issued them to everyone in the country, prompting everyone to go out and buy sports cars. Still, there are only a limited number of sports cars in the country, so the logical thing to do would be to raise the price of the sports car. An analogy we can use to demonstrate this is 4 people on a deserted island with 10 pieces of fruit each. Each piece of fruit has equal value. Suddenly, they find an entire forest of apple trees. As there are more apples, its nominal value has increased, but the actual value has dropped due to an increase in supply. Consequently, it now costs 10 apples for 1 banana since there is low demand for apples but high demand for bananas. In this analogy, the people represent different countries. The fruits are their respective currencies, and the apple tree is the printed money. It isn't just economic theory that indicates printing too much money is a bad idea. There are numerous examples throughout history. According to estimates, monthly inflation in Zimbabwe during the 2000s reached as high as 80 billion%. Eventually, the local currency was abandoned in favor of the US dollar. In the 1920s, hyperinflation was a famous event in Germany. People were seen bringing wheelbarrows full of cash to shops shops to pay for basic goods. While the spiraling prices in those days were primarily caused by the punishment of reparations payments instead of printing money, it still illustrates the problem. The presence of a little bit of inflation, about 2% per year, is considered a sign of economic health, but too much could quickly sabotage the economy. Central banks have experimented with quantitative easing in recent decades to inject cash into the economy while retaining a low inflation risk. This approach involves central banks purchasing bonds issued by another entity to increase cash flow. Bonds can be purchased by anyone from corporations or governments. Buying a bond is like lending money to a company or government with a promise that they'll pay you back with interest later. It's for this reason that buying bonds is also called buying debt. If you purchase a bond, you're using money already in circulation. But when the central bank buys a bond, it effectively creates cash, supplying money that did not exist before in exchange for bonds. During the 2008-2009 financial crisis and in 2020, the Federal Reserve purchased treasury bonds, which are bonds issued by the US government. These bonds have historically been viewed as a safe way to invest money, knowing the government will pay back the bonds with interest. The Federal Reserve pledged in early 2020 that it would purchase unlimited treasury bonds, loaning the US government with unprecedented funds. These were funds that the government used for relief efforts such as stimulus checks and unemployment benefits. Despite sounding similar, this isn't the same as simply printing money. With the way bonds are priced, the Federal Reserve effectively lowered their return by buying so many, encouraging other investors to lend to riskier entities such as small and mid-sized businesses to earn a decent return. Through this type of lending, companies of all sizes can borrow money for projects and hires, thereby boosting the economy over time and helping the government provide urgently needed cash to people in the short term. Questions and eyebrows have been raised over the Federal Reserve's pledge to buy unlimited government debt. In theory, this could allow the government to issue more bonds, which the central bank would buy. Using the money from the new bonds to pay off the older bonds would mean that the government would never have to repay its debt to the central bank. Citing this and other theoretical scenarios, some economists have expressed concern that the purchase of government debt by the central bank is a subversion of a system designed to protect the economy. Others have argued that these measures are necessary and have helped stabilize economies so far. Despite being more common in recent years, quantitative easing is still relatively new and its potential effects are still being determined. A more technical reason why governments can't just print more money to pay off debt or pay for spending is that they don't have control over it. Most developed countries have central banks that oversee the money supply, such as the Federal Reserve, the Bank of England, or European Central Bank. The central banks operate independently of the government, although they sometimes coordinate activities. Over the last decade, central banks have churned out billions of dollars into the economy through quantitative easing, which are programs that print money to stimulate growth. By purchasing debt, central banks free up cash that can be invested elsewhere, hopefully in businesses and new technologies that are economically productive. However, central banks are only concerned with the economy's health rather than broader government issues such as defense, education, or healthcare. Separately, a country's central bank directly financing the government could cause international investors to lose confidence in it. Monetary supply and exchange rates should reflect a nation's economic size. When central banks pump out more money to pay off their debt, it's almost like a snake eating its own tail. If this were to happen, exchange rates would likely fall, leaving a country poorer and everyone else worse off. I'll leave you with this final thought, which is perhaps the best way to summarize why governments can't just print off unlimited amounts of money. If money grew on trees, it would be as valuable as leaves. And that's all the time that we have today, folks. We hope you enjoyed this video, and if you did, please hit that like button. If you're new around here, subscribe to our channel to remain updated about all of our future videos. We'll see you next time.